Yo, what's happening? This is my second shot at trying to record this thing. I don't know what's going on with computers today, but they're not my friend. Been at fighting this computer since 4:30 this morning. So let's talk about the markets, of course, right? So well, part of the markets, what we've been talking about. Another good friend of mine, Pat, said this to me. Wall Street, like we've been saying, they're out there getting at it. This is Yahoo News, guys. Check it out. We're not jerking you off with what I'm telling you. These guys are trying to take control of the housing, turn everybody into renters. We've heard it talked about. It's not some conspiracy. It's the reality of what is being done. It's a business ploy, right? It's a business play. And if you can turn everybody into somebody's paying you something all the time, think about that. There's 7 billion people on the earth. If you get everybody to give you $1 damn a month, where are you at? Right? So in this situation, they take over all the housing. If you've invested with the hedge funds, they're using your money to take the houses from you and then send them back to you, right? It's the same thing with the banks. They're literally, you put your money into a bank, checking account, savings account, CD, anything like that. You're putting that money in there. They're paying you nothing to hold your money, and then they're lending it back to you at a profit. So that's how the banking industry is constructed. Now the investing industry is doing that. They're taking it from the housing side. So I'm not telling you anything you shouldn't already know or shouldn't already see. And it's all over out there. The only way for you to take advantage of what's going on with what they're doing, we're not going to stop them completely. We can slow them down by buying the houses that's there. You be the investor. You acquire it. They're going to be pushing these home values up. They're going to be pushing the rents up. They want to make money. You might as well ride along with it. Get some of it. And if you think you're going to wait till the rates go down, you're sorely freaking mistaken. I'm not even going to get into that again. If you're right now thinking, and this is your first time you're watching me, the rates are going to go down, or this other lender said, we can get a short-term deal, or I'll give you a free refi when the rates go down, call me. Let me spend 10, 15 minutes just explain to you what's really going on. I've been at this since 1997. I've got team members that have been at this since the 70s, and I'm not kidding. There is a lot more at work here than what you've seen in the last decade. The last decade's been something that's been an anomaly since 2009 that should have never occurred. Honestly, that window of time should have never happened. We should have never seen the quantitative easing do what it did. We should have never seen interest rates below really 5%, but we did. And what did that do? That's really more crippling than it is a benefit. That we'll talk about that. You contact me, I'll explain to you why that was a crippling thing. It should have never happened. It's actually hurting us as a country. Now, what we have today is the CPI came out, or the PCE came out, the personal consumption expenditures. Everybody's familiar with the CPI, the Consumer Price Index, a measurement of inflation. Now we have the PCE, the Personal Consumption Expenditures Index, that the Fed looks at, and that was slightly better than what they expected. Therefore, we had some improvement in the mortgage-backed securities today. There's also some evidence out there of a little bit lower spending, and because that lower spending, it means that some of the costs of things might go down. If people aren't buying it at a feverish pitch, there's going to be some inventory growth. The more inventory goes up, the more the prices go down. It's like real estate, guys. That's the problem we have with real estate. The inventory is not going up. It's still below demand. So as long as the demand is higher, what the inventory is there, the price will be higher. It's interesting. Warren Buffett invested or Berkshire Hathaway invested into home builders. Never did that before because of what's going on right now. They can build it for cheaper than what they can sell, and they can make a pile of money. Let's look at the charts. So what I'm following right now is the Fannie or the UMBS, Universal Mortgage-Backed Security, the 6.0. The 6.0 means that whoever invests their money in there, they're going to make a flat 6% return on their investment. That's lower than inflation, guys, significantly lower inflation. So they're not making their money off of it. They're losing money the longer you're in this deal. Now, they're going to make some decent money for the first 5 years because all you're paying is interest. Think about that. For the first 5 years on this, it's mostly interest. So they're doing very well on you in that first 5 years. But after that, it starts to get to where it's going the other direction, probably within the first 15. So use that to your advantage, right? Play this thing out to 30 years. They lose money the longer you take to do it. And we'll talk about that too. If you don't understand that concept, contact me. Reach out to me. Go to the apps. Actually, just send me your email. Reach out to me and say, I want your inflation app. I've got an app that you can calculate this and see how you're paying less than what you borrowed. And that app I give to you for free. So what we're looking at here, the mortgage-backed security shows every single day is evidence with one of these bars that's trading. And one of this movement here references, here's where it started, here's where it ended. It was a positive day, money flowed in. And when you're talking about a negative day, let's look at this one. Here's where it started. it went really, really negative. Actually, it went positive for a while, but really negative. And we went on a negative day, meaning money flowed out. There's been enough money flowing in and out at a level that's kept us going at a slow decline. That decline means interest rates are going up. Less and less money is being made available in these pools. Therefore, rates are going slightly up. Now, this person's still going to make 6% on it, but there's going to be more cost to you to get the loan from them to only make the 6% because of all the stuff that's going on in the middle. There's other things that are at work here that has to go for that. So just letting you know, to make them whole, that 6%, there's other costs that you have to get hit with. Right now, we're still in that decline. We're watching this channel. We got into it this morning with the news from the CPI. We didn't keep in there. Hopefully we break in there. We stay there because we want to follow this particular chart. It's called the stochastic indicator. You get up in here, he's been putting too much money in there. They're likely going to sell off. Get down here at the bottom. They've been selling too fast, and they're likely to start buying in as far as the bond traders. So we're in that lower point. Hopefully get up in here. Then we want to lock as it gets here before this starts to drop out. So we're going to see this this peak hopefully up in here when it hits all the moving averages, lock a bunch of loans, and move on. Appreciate you guys. We are going to be getting more information for you on Tuesday. It'll be October finally, and we'll see how this all plays out. But start buying real estate. If you're not, you're losing out, and you're going to keep losing out. And the next generation is not going to get anything.